So this sort of design work by well-trained lawyers is a sort of constant threat to the thresholds which are laid down in treaties, particularly where PE is concerned. At the same time, it may be recognized that it may be very helpful in particular cases where a taxpayer will have a PE, particularly in instances where income would otherwise be taxed for its gross amount. And I'm thinking of dividend income, interest income, royalty income, technical services income, other technical fees, type of income. All these cases are typically subject to withholding taxes that are applied to the gross amount of the income. And well, the withholding tax may, under particular facts and circumstances, tax away the full amount of the net income because the expense level is so high that the low rate withholding tax will wipe out the entire amount of the net earnings. In such a case, having that income earned through a PE, the income will switch treaty rule. It will move from 10, 11, 12, or what have you, to Article 7 and be taxed on a net basis. So indeed, if one deals with withholding tax rates which are in a given case too high in respect to the net amount of the income, a PE may come in very handy to make that income that normally will be taxed on the 10 through 12 for its gross amount, have the tax only for its net amount. The last paragraph deals with an issue that Michael Lang already explained, the use of a permanent establishment. That still works. The OECD is trying to fight it now effectively, but under most treaties it still works, that if the taxpayer is a resident of a exemption country, that he receives his dividend, interest, royalty income through a third country permanent establishment. Income is going to be exempt, and therefore the low tax rates which are applied by the source country to the dividend, interest and royalty income as a result of the treaty between the residence country and the source country, those low tax rates don't get sort of added on by a higher tax in the residence country, because the low tax rates are preserved. It's going to be income of the PE. If the PE is in the low tax country, it will qualify for an exemption in the residence country. That's all the tax there is. Just give you a little glimpse of sophisticated tax planning that goes on in this particular setting. So very briefly, residence country, PE country, and then the country where the dividend, interest, royalties are coming from. Income attributable to the PE. What has been tried in this regular situation to have the dividends, interest and royalty income attributable to the PE, that income will also qualify for the application of the treaty between the residence country and the source country of the royalties. So whereas that income is already exempt as part of the PE income, it will independently qualify as dividend, interest, royalty income under the treaty between the source country and the residence country. So technically one could get double relief, namely directly from the source country to the residence country, and indirectly from the source country through the PE country to the residence country. So an exemption here and a credit there. So these are these typical things that one runs across when you really get into the fine points of PE taxation and attribution of income to such a PE. One thing that we have all heard about and understand, and that's sort of important to realize in the view of the discussion regarding BEPS, that making profits is something entirely different from having a big turnover. If Amazon or Google or Starbucks are selling their products for enormous amounts, gross amounts of revenue, that is no indication whatsoever of the net profit earned there. Net profit is generated by value, and value is rarely accomplished through sales. Value is created somewhere else. It's sort of in the mind, in the perception of the unaware, of the people who are not trained in tax matters, and even when I teach first year tax students, when I tell them about two brothers working together, one making beautiful furniture but not being able to sell anything because he's very gifted with his hands but he doesn't have any commercial mind, and this brother is commercially very gifted, he cannot make a thing but he can sell you anything that you don't want to buy. At the end of the day, when the profit is made, the question arises, and who made the profit? And many students will say, well, the guy who sold the products. And it does take a little thinking before people realize, who have never sort of dealt with this problem intellectually, that there is a value created somewhere that isn't realized right away. You've got to recognize that the guy who made the beautiful furniture may have made a large contribution to the eventual profit that was being produced. But that does require a bit of explanation, which is very difficult to do when you write on topics in newspapers. So this whole misguided discussion on the way that these companies operate is sort of painful for the companies and painful for countries, and that's including Holland, because Holland is certainly one country implicated here about the way they deal with the tax issues involved. I think I'm going to skip this, and if we look at how business in the old days was done by a company which is a resident of one country selling in the other country its products, its physical products. They were typically, in that scenario A that you see on the screen, typically sold to a local establishment that clearly would qualify as a permanent establishment if it was maintained for a longer period. If we go to scenario B, we see there that a customer doesn't buy anymore from a local establishment, but through a sort of a mail order setup, where he will order things by letter, by phone, whatever, products which were being shipped from the other country to the country of the buyer. Goods will be, of course, physical goods will be physically delivered, and the question is, how much of taxing power remains still with the country where the sale actually is taking place? Of course, in the absence of a place where the sale is affected, maybe only a warehouse will be maintained in the country where the consumer lives, a warehouse for which the goods are going to be shipped. Under the current rules, the warehouse may even be exempt through Article 5.4, the ancillary activities. Maybe for a mail order business, the warehouse is not that ancillary and it will not be accepted. But still, the profit attributable to a warehouse is of course only a fraction of the profit attributable to the entire sales transaction. So that is already a major reduction of the possibility for the sales country to tax. If we go one step further again, C, and we go to digital ordering of goods which are physically delivered, we are pretty much in the same scenario as we were with scenario B. The ordinary sales profit will not be fully taxed anymore, and the only thing that perhaps can be taxed still by the country of sale is if the delivery takes place through a local warehouse where the stock of goods is maintained that for which the deliveries are made for local clients. The issue, of course, has come up about if you buy through a website and that website is generated by a server, and that server is going to be maintained within the territory where the sale takes place, whether the sales proceeds can be attributed to such a server. And the OECD has, many years ago, 50 years ago, they started studies that resulted in a viewpoint laid down in the commentary that a server as such can be a permanent establishment. Which is true, because a server is probably pretty fixed, it's going to be there for a longer time, and so the income which should be attributed to the server should be subject to tax in that country. But here we get to a core issue which is going to be important also for the whole BEPS developments in the next few years. Finding that something is a PE is only the first step you're going to take. And the second step is, and how much income is attributable? What's the test for that? We have to make the PE into something that will be carried on by a separate enterprise. So a server, a piece of equipment, which is operated by a separate enterprise, how much would a separate enterprise earn with that server? Is that the sales income generated by the server? No. The software on that server is not something that was created in the server country. That software was put by the foreign company on that local server. So the software is something that was sort of, if you're going to deem the server as independent, you've got to assume that the software was purchased or leased or taken under a license, which is going to be paid. So the real income of a server is minimal. It's only the income that you earn by having a piece of equipment on which software is running that's not yours, that the piece of equipment keeps running. Well, the profit is going to be marginal, so the whole discussion of whether a server is a PE is pretty senseless, because the income attributable is so tiny compared to the overall turnover that goes through the server that the whole discussion isn't worth the time that you need for conducting it. So, keeping that in mind, I must say, every time I look outside, to me it seems it's snowing, and then I think that cannot be true. I'm in India, I'm in Mumbai, it's going to be showing. Because all the water going down that looks like wet snow coming down, but I know by now it's Where are we heading with the PE? It's perfectly clear that the thresholds we use today under the OECD model, under Article 5, the physical PE, the project PE, the agency PE, don't represent at all the business which is very strongly arising in the Western world. I do not know any figures for this part of the world, but in Western Europe, sales of consumer products are made in many countries for over 25% already through the web. Of course, physical goods are going to be delivered physically, but as we saw earlier, that doesn't give rise to much taxing base for the country. And of course, digital goods can be delivered without any physical presence of the selling company at all in the given country of sale. We hear in the whole BEPS discussion surprisingly little about new dimensions of PE in future treaties. There is some talk about a virtual PE. And I can imagine that you call, for example, if you sell more than, let's say, in a Western European country, 10,000 euros worth of goods in a country through the internet, that you are deemed to have a PE. But such a deeming rule isn't going to work for the original purposes for which the PE was set up. Remember, we want to audit, we want to collect, and we want to have a measure that can be easily applied for making a comparison to an independent business. How are you going to compare, selling for 10,000 euros in a country? How are you going to make that sort of comparison to independent business? So the virtual PE as such won't fly. The most basic requirement that should be met can hardly be met. So my personal view is twofold, and then with giant steps we are getting to my last slide. There are two possibilities in the long run. And the first possibility is that we simply give up something that OECD so far, through the transfer pricing guidelines, has been very hard to push, namely trying through a physical presence in the country to an establishment of transfer prices to establish how much income can along those lines be attributed to the taxing power of the country. I think with the ongoing digitalization of our economic world, this is going to be a losing line. The way to proceed will be, and it's a difficult way, but the EU is working on that for within the European Union. You may have heard of the corporate consolidated common tax base. Within Europe, they have worked for a period of over 5 years to establish an agreed upon definition of what is corporate income. Apart from all the national definitions that are used for domestic tax purposes, this common definition is going to be used for cross-border activities of multinational enterprises. And rather than trying to tax each and every subsidiary, branch, or whatever activity such a multinational enterprise has in each of these countries of the European Union, the point is, how do we establish the EU-wide profits, and how do we reallocate those profits for taxation by these individual countries? So the idea is, rather than for every country establishing particular threshold like PE or having separate companies, rather than doing that, establish the profit for the whole area and then redivide them. A bit like they do in the United States with state taxation. As you may know, they call that an approach where through a formula apportionment, the US-wide profits are reallocated among the states. This needs an enormous joint effort to make sacrifices, to reach compromises, to obtain such a negotiated formula of what is corporate taxable income. But if that's going to be working in Europe, I do hope it's going to be the model for a much larger area. Because only in such a case, nothing will escape. In such a case, countries can develop yardsticks to apportion that big pie to all the countries concerned on whatever basis that can be negotiated. You can say we're going to allocate that income on the basis of sales. We're going to allocate that basis on consumer power. We're going to allocate that based on the basis of value added. It's free. We are not bound anymore by notions like permanent establishment that seem to belong to an era which is almost over. Question is whether it's going to work. So again, the first test is going to be in the European Union to develop this. And if that works, hopefully through international organizations it's possible, OECD of course will be the most likely candidate, to have this method also applied at a much wider geographical scale. The big step to make is a step away from arm's length. And the question is whether...
Step away from?
I'm sorry?
A step away from?
Away from arm's length. Arm's length has been the big central goal of OECD through the transfer pricing guidelines to get it accepted sort of a worldwide basis. Now, if we look at the effects of internet, of the digitalization of our economic world, we see that countries that don't meet anymore the technical threshold like PE to be able to tax, we have to give them a new opportunity to share in the revenues that are going to be produced. So that means that OECD has to give up something they've been fighting for very hard. And the question is whether, if Europe is going to be successful in further developing this idea when OCD is going to take it over. This is not something that will happen tomorrow or the day after tomorrow. It's something for the long, long run. If it doesn't work, it may very well turn out that corporate income tax will not be a tax that will be with us in the distant future. It may be a tax okay for local undertakings, it will not be a tax that's going to be acceptable for cross-border ventures by multinational enterprises. So far my presentation on this topic. A few words on Leiden perhaps. I do have a okay. Okay, well these are the happy faces of our current students who arrived about a month and a half ago. We have in Leiden, a little different from Vienna, we have every year between 40 and 50 students. We have 3 countries which are, we have two regions in the world where we have most of our students from. I would say the Southeast Asian region and the Latin American region. So as a result we have many applications from India, from China, from Brazil. And from these countries and from each country we never admit more than 7 students in order to avoid that particular countries will too much dominate Leiden. And Leiden is a very small town. It's an old university town. It's 100,000 people, so we should not have a huge influx of Indian people or Brazilian people or Chinese people. Anyway, this is an aerial picture of center of Leiden, and you see in the left top you see the yellow line there, which is around a building which is the International Tax Center Leiden. The International Tax Center Leiden is an independent legal entity within the law school of Leiden. So we have the luck that we are part of the university, but legally we are not bound by all the red tape that the universities produce, like big companies. We can sort of run our own things. And here you see the building again. It's a big building there, which was built, you won't believe it, in 1420. It has been changed quite a bit since, but it's now over almost 600 years old. And that's where we operate our teaching, our research, our training for our doctoral candidates. Well, these are pictures, I will go quickly through it, of the interior of this old building. You have a huge garden at the back side, and at the left side you see the new wing of this particular thing where we have our new lecture halls. It is our new lecture hall that accommodates 70 students. You see me lecturing there. I wear a bow tie now, I wear a bow tie there, but not always. Sometimes it's far too hot to wear that. This is our new building, see the back side and the view. The kitchen for the students. I don't know what sort of kitchen you use as a student, but mine was not halfway as nice as this one we have now available for our students. Student rooms, we have about 30 students that can live in the facilities of the ITC. This is, by the way, a Chinese room. Why? For Chinese students, as you may know, they live as a law student and accounting student, they live 6 students to a room. There are 3 bunk beds, and well, the students have their own room, but when they came to Leiden, they said, we don't want to live by ourselves, we are not used to that. So we made special room for Chinese students where 2 students can share a room, you know, upper part, lower part. Individual bathrooms, you know, studios and so on. The second building we have with kitchen, rooms for the students, you know, also older things in the attic. But maybe more important than the rooms and all the facilities there, let me tell you a little bit about the program. It's a 12-month program. Students arrive at the end of August, and different from the United States, don't study there till April or May. No, they study till the end of August. So we don't have summer holiday. We end on a Friday and we start a new semester on the Monday thereafter. It's a program where the whole curriculum is divided up in courses. Every course ends with an exam. Right now we are on the tax treaty course, which is the longest course. It's over 200 hours, just tax treaties. At the end there's an exam, and then we start with transfer pricing. So people can come for the whole course, will get a degree. People can come for a single course, don't get a degree, but you know, get a certificate for having passed the course. And if they want, they can later come back and do the whole thing, if they prefer that. The program is, our main program is an international tax program. Actually, what I was telling about the tax treaty course and so on. This year we also started a EU tax program, also important for people from here perhaps, but very important in Europe, particularly with the state aid developments, enormously important, even more important perhaps as a threat to companies than tax burdens. And we are preparing a transfer pricing program, hopefully to start in 2016. Full 12 months of transfer pricing, both the accounting side and the litigation side, which is equally important. What else to tell? We're fairly comparable, Vienna and Leiden. We also have like 600 alumni. Last night we had an alumni meeting in the Mumbai Cricket Club. I must say it was the first time I was in a cricket club, but it was very pleasant, and it was very nice to see both many alumni from India, of course, and people who had traveled from all over the world to come to the Mumbai IFA to attend that, and at the same time to be together with our other alumni from Leiden. We really try in Leiden to build a sort of a family feeling for the students there. It's very important for people, young girls and guys from all over the world, who are young, I mean they are between, I would say, 25 and 40, to feel at home. Often they are from far away, sometimes from protected environments like in China, and it's important that they flourish well. So we provide a social setting and with a lot of social activities that makes them feel comfortable. We also make them study together, so they will discover early when there are misunderstandings. They will learn from one another. They learn a lot from one another. Every year we have at least one marriage among 2 students, and so far we have almost 20 marriages. Children from those marriages qualify for free tuition 20 years later when they have the right age to come to Leiden. And in this way we guarantee we're going to have an ongoing program for many years and many decades. I think I'm a bit over my time. Thank you so much. Thank you for your attention.
Thank you, Professor Van Raad, for giving us a glimpse into what the future holds. So far as the concept of PE is concerned, attribution of profits, because we were wondering, the way things are going, it's getting more and more complex. And from what you mentioned, I think there is some hope, some light at the end of the tunnel for the complexities which are coming up. I think we already, Professor Van Raad is already getting late for his next appointment. I would request Mayur to propose a very well-deserved vote of thanks.